All right, without further ado, this lunch panel, as I said, has been always a fan favorite. Glad that we got this particular panel together. It's going to be great. I'm going to turn it over to Jay Duke. Jay's the National Managing Partner, Advisory Services, right? But how many accounting professionals report to you, Jay? 2,000. 2,000?
Yeah. As of today, I haven't.
Who's sick today? Congratulations. That's an amazing role, and we appreciate you taking time out to do this. I know you have many things to do. Without further ado, Jay Duke.
All right, you guys ready for a kick-ass session? Let's hear it. Let's go. Getting old, so I got to break out the glasses, guys. Sorry about that. First of all, it's wonderful to be here and see all you guys, all the friends, new friends, old friends, and all that. I will tell you, I was in Park City, Utah, when the word came down from the NBA that things were going to be changing. I'm sure I was about 10 shots into the evening. Where's Ryan? Is Ryan in the room? Zach? I know Zach was there. Tim? We were all there. First thing I did is I got $20 out of my pocket. I walked up to the band and said, "Can you play It's the End of the World?" And I feel fine. So glad we're all back together, guys. And I really, so far, I've really enjoyed Rob's keynote. I thought that was really, really exceptional. And I think it really ties into what we're about to talk about. He talked about some really good fundamentals about running your operation. So let's kind of talk about what we're here to do today. So preparing your business for the next level of growth and third-party investment is our discussion point. Why is this important? Because you want to do this right. This is likely the biggest asset you guys have. And to do it well means that you might end up sitting on the dais being an investment banker or something like that. Do it poorly, and you might be working for an accounting firm. Just saying. So anyway, we put together an amazing panel. I want this to be an interactive session. These guys don't want to hear me talk, and I certainly don't want to hear them talk. So the idea is, as we get things started and we get some introductions going, let's get some questions, because this is a unique opportunity to hear from some people that have actually physically done it. And that's what's important, right, guys? Yeah. Okay, so without further ado, let's get to some introductions. First, to my left, Anthony Pelosi, President and CEO of AP Franchise Concepts, venture capital firm focused on emerging multi-unit brands. He's invested in 8 emerging brands across restaurants, retail, fitness, and provides capital as well as expertise. Anthony, tell us a little bit more about yourself.
Thanks, Jay. My business, I started about 5 years ago, really to bridge the gap between founders who had kind of proven their concept, gotten up to about 5 or 10 units, and the guys on my left here, Jeremy, who, in PE, who are looking for brands that are 50, 100 units and above. And to get from that spot of kind of that 5 to 10 units to that 50 to 100 units, you heard it, I think, quoted earlier, a lot of brands don't make it. And it really has to do with capital, it has to do with expertise, it has to do with really executing day to day. And so my firm's really about helping brands make that transformation and bridge that gap and get to that size and scale where the monetization becomes really meaningful.
Anybody need that kind of help? Anybody? Yep, I think so. Next, I'd like to introduce you to Grant Marks. Grant Marks works at Riverside, and he reports to a person named Jeremy. Wait, just in. We have, not Grant, who's an amazing person, but we actually have the top guy. We have Jeremy Holland, who we've worked with for years. We love Jeremy, we love Riverside and all they do. They're focused on being one of the leading private equity options in the marketplace. Grant, who you guys will meet off and on throughout the week here, he is the subject matter expert on franchising. A great group, and Jeremy, you want to tell us a little bit more?
Riverside is perhaps one of the biggest private equity firms in the world that's both global in scope, but has remained focused on the entrepreneurial end of the market. We've invested behind more than 40 brands across many different industries. This group knows us best for our multi-series of partnerships with the Dwyer Group, now called Neighborly, which we just had our final exit of those 3 different investment periods on September 1st. And so that dates back to 2003. But we're actively back in home services, focusing on the smaller end again and helping entrepreneurs get back up the end of the curve. We also have other multi-concept strategies, including senior services, and we're working on a few additional sectors now.
Yeah, very, very good. Next is a gentleman you probably heard a little bit about earlier today when Dave was talking. We've got Josh Skulnick, CEO of Horsepower Brands. You may know Josh as a serial entrepreneur. He began with a successful landscaping business. You know it as Monster Tree Service. He started from scratch, grew it to over 240 territories in the United States. And then, what I'd really like to talk to you about, Josh, and just you and me talking here, how did you come up with the concept of merging a dumpster with a porta potty? How did Redbox Plus, how did this happen? It's so obvious, yet.
Well, fortunate for me, I was successful in the tree care industry first, so I was introduced to the founder of that business and actually acquired it when there was approximately 4 locations. He had come up with a unique idea of merging the porta potty with the dumpster, patented that, and then we took it national. We grew it in 3 years to over 305 franchise units before exiting that investment in June of this year with the assistance of Patrick Gallagher here to the Belfour Franchise Group.
So tell us what you've been up to since then.
So recently, my business partner, Zach Butler, and I have launched Horsepower Brands, and our vision is to acquire emerging home service brands. We've got a targeted acquisition list of 12 industries that we want to be in, very targeted and calculated in what we're doing, what we're looking for in founders that we work with. The first acquisition we made was a brand by the name of Mighty Dog Roofing, and we successfully awarded over 150 franchise units year to date, and we recently completed our second acquisition in the holiday lighting space with a brand that we're rebranding to the name Blingle, and we're not only going to be doing holiday lighting, we'll be doing event lighting as well as outdoor lighting in addition to that, so it is a full year-round business. And so in addition to that, we have 2 additional brands under LOI, and we expect to complete the 12 acquisitions by the end of 2022.
And when you're done, you're headed towards $1 billion of concept revenue, correct?
Absolutely.
And is Blingle, did you pick that because it rhymes with Kris Kringle? The audience wants to know.
We just wanted to put a little mingle in your jingle.
Very good. And a person to your left who has helped you through many of these endeavors, Patrick Gallagher. This man's resume goes on forever. He's the managing partner of Boxwood Partners, a boutique investment firm based in, can I say it?
Jupiter, Florida.
Jupiter, Florida, and other places, points beyond. Also in Richmond, Virginia. He leads transactions for Boxwood on the sales side, M&A advisory practices, and he has led multiple transactions, including the merger of the dumpster and the porta potty. So we've got this gentleman to thank for that as well. But the list really goes on, and you know the things that you've accomplished working with public companies, educational background. Why don't you tell us a little bit more about yourself, Patrick?
Well, thanks, Jay.
Yeah.
Welcome, everyone. Appreciate the chance to speak to you. I've sat on a few panels with Josh over the years, and it's always informative. Josh has done a great job at building companies, and we've really enjoyed representing him on exits. And what we're going to talk about is trying to get things right before you go to market, try to raise capital, or sell, or bring in an investor. So. A little bit more about my background. I got lucky and took my first company public when I was 28 years old. So learned really, early on in my career, you got to get things right on the front end and make sure you build the company right to get through the process. And, as a firm, we really pride ourselves on doing a lot of work before we actually enter the market with an opportunity to bring in third-party capital. So, one of the things that hopefully everyone takes away is, the pain on the front end of a transaction, or when you're doing your first FDD, is well worth it later on, because hopefully most of you are growing your franchisor to sell it eventually. And making sure you get all your FDD receipts and that you actually structure your royalty stream correctly. You don't give people special terms just to get your first 5 or 10 or 20 franchisees in the door. Those things come back and bite you 5 years from now or 7 years from now. So, hopefully, at the end of this panel, everyone gets some useful tidbits to take away that helps them better build their franchise franchisors. And, good accountants, good legal are critical. And Rob mentioned that earlier, but we see a lot of FDDs that come through, and they obviously hadn't had a law firm like Lane representing them. And it really makes the process more painful down the road not to have a good auditor and not to have a great legal firm. So,
Very good. So that is our esteemed panel. Round of applause for our panel. So before we get started, just to kind of level set, how many people have 0 to 10 units or more? How many have between 10 and 25? 50 plus? Okay, so you guys now, you see our demographics here. You know what we're talking about. So let's get to a common language. When we're talking about third-party capital investment, that can mean a lot of things to a lot of different people. When you guys think about it, and from your direction, the way you guys do things, tell us about the different types of third-party capital investment. I'll start with you.
Sure. Well, as you can imagine, when you're looking for third-party capital, you can really, it can run the gambit. It can be anything from, a few $100,000 from some friends and family to help you run the business to, a big buyout with a very experienced private equity firm. And actually, I think one of the most important things when you start to think about raising money is is really understanding what you want to get out of it, right? And, you really need to go in with a plan as to, what you're trying to get, what type of partner you want. Because when you bring on capital, you bring on responsibility and accountability to those people. And so you really want to go in with the understanding of what you want to get out of it and make sure there's alignment in that.
So Jeremy, there's venture capital, there's private equity, there's strategic, there's a lot of different avenues here. Can you explain the difference a little bit to us?
Yeah, so truth be told, private equity is the overarching name for all of those things, but leveraged buyout firms got a bad reputation in the media from misunderstandings and some high-profile investments decades ago. And so the leveraged buyout firms adopted the phrase private equity. So today, private equity could mean a leveraged buyout firm, or it could mean the whole asset class of venture capital and different types of non-public investment structures. So the venture capitalists, the key difference is really just their willingness to sustain very large losses, frankly. Otherwise, we're legally structured the same way. They're limited life partnerships, typically 10 years with the opportunity to extend, and we have control of a pool of capital, usually from pension plans, state pension plans, university endowments, insurance companies, ourselves, to invest in that period of time, but we have full discretion over that capital. And for franchising, most venture capital firms have not gotten involved. They're looking for the next Facebook or the next cure to cancer, whereas we are much more focused on companies that are closer to break even and above, and they're more willing for businesses to lose money for many years in a row.
Patrick, anything you'd like to add to that?
I think the one differential in today's market is private equity-backed strategics. So, especially in franchising, you've seen the Neighborly's backed by Harvest and now KKR, Apex back in Authority Brands, Riverside back in Threshold. It's not just a PE versus strategic anymore. It really is. You got three categories. You got private equity that might want to start a new platform with your business. You have a strategic that might just want to acquire you and cut have some cost synergies. And then you have private equity-backed strategics that, in our view, is one of the best buyers / investors for brands in the franchising space, because they're all about growth. I mean, every single aggregator or franchisors right now in the market, they're trying to grow. They're not trying to cut costs. They're trying to invest behind their brands, build the brand in the marketplace, and then acquire other franchisors to fit into it. So they're trying, as Rob spoke about earlier, they're trying to get the marketing right, the systems right, the IT, so they can plug in more brands like yourselves and grow those systems and grow the fran dev. So that's if you look at a lot of our deals, a vast majority of our deals are going to strategics that are already backed by private equity, which and that gives the founder a lot more flexibility in whether they want to stay on. Like Jacob at Duty Calls stayed on with Authority Brands, where Josh left to focus on Redbox and now Horsepower Brands. So PE-backed, back in a strategic gives you more options.
Yeah. And I'd like to clarify that. There was duty calls, not booty calls, because my mind just goes all kinds of places. Josh, you've been immensely successful in what you've done. I mean, from the beginning all the way to exits and all that. You must have had lots of people coming to you throughout that path. You probably had different types of people involved, offering you different things. You made a decision to more or less exit entirely, correct? Tell us about how you decided on which way to go and why.
Yeah, so I first began franchising my first brand in 2012, and around 2016, I was 4 years into the venture. I had approximately 28 franchise units, and Rob and his team at Authority Brands had reached out to me in addition to probably about 100 other PE groups that were really after trying to acquire the business. And I really went somewhat down the line of looking at that option, probably went the furthest with Rob and his team at Authority Brands at the time. What I really learned through that process was how much I could really scale my business. And for me, it just didn't seem right. And I would credit probably Bill St. Clair sitting in the audience down here, because I'll never forget, we've worked together for years, and he said to me when I was talking some of the numbers, he said, listen, that will change your life, but he's like, I know you're an entrepreneur, you can really grow this thing, take it the distance, and you're really just in a rough patch currently. Because I had awarded 28 franchise locations pretty quickly, didn't know what the hell I was doing, and really had to pause development for a while, really dial things in and refire all cylinders. And it was really Bill's advice at the time that really gave me the drive to want to continue. And so I took everything I learned in that process and really just implemented it and continued to build. And when it came time in 2020, pandemic hit, we were growing like crazy, being in home service. These calls kept coming in, and they're hard to fend off sometimes because they can be tempting, to get the big check. And we were fortunate, Patrick and I had linked up a few years prior to that, and Patrick would call me probably about monthly. When are you going to let me sell your business? I'm getting calls weekly. People want to buy it. You're the only guy in the tree care space in franchising. And I think he finally broke me down around March of 2020. It was, I think I engaged you actually in February. We went to market, and we had a successful transaction with Rob and his team, including Apex, backing Authority Brands. And my exit was a unique one because I really believed in my brand, so I was able to take chips off the table, continue to move on, have the right teams in place to manage that business. Rob mentioned this morning in his presentation about the management team that I had rolled forward with the business. And that was a big focus of mine, making sure that I was able to remove myself from the day-to-day and be able to roll that team forward. And I believed in my brand so much that I rolled forward in the investment with Authority Brands. And it's been fantastic to date.
Yeah. And so you made the decision to sell 100%, but that's not always the case, right, gentlemen? So give us some scenarios, whoever would like to take that, where you may not sell 100%. You may actually sell 51% or even less, even a minority. Why would someone do that?
I think the key thing is to remember it's your business and there's a lot of different options. So you can do what you want to do. There is an investment firm that will align with your culture and the strategy that you're looking for. The example I was using in the hallway an hour ago was Rick Nanell at Window Genie when we were a control owner of the Dwyer Group before they rebranded Neighborly. We wanted to be in the window cleaning business and boiled the ocean on the concepts out there and settled on that one. And Rick thought, I'm young, I'm healthy, my team's great, we finally got this thing figured out, it's humming, why would I sell my business? Makes no sense. And we brought him down to Waco to tour the campus and look at some best practices and said, look, worst case scenario, maybe you learn a few things from Mary and Mike and just, hear us out. And I like to tease him that he's right and he's wrong. He did not, quote unquote, sell out, as he used to word it, because he didn't sell 100%. He took a little bit out to deal with some tax purposes and things like that. But he largely rolled over once he got in under the hood and saw what we were building there. And as a result, amplified the end result for himself because he bet on the greater upside opportunity. But with people out there like Anthony and mezzanine firms, which is a type of debt that kind of straddles in between, regular debt as you think about it from a bank and equity. There's all flavors of transactions you can do, including you maintaining control, but also getting access to resources. So don't feel like it's a binary outcome.
Yeah, it's not really one size fits all, is it?
No, it's not at all. And one of the things we're seeing in a lot of cases is, especially with the aggregators, is the founders having the ability to reinvest in the greater entity. So you're not just taking chips off the table, you're getting to invest, kind of sidecar along with really smart private equity groups. So, we've got many clients who have made just as much, if not more, when they end up exiting that small portion they rolled forward. So, say you did a $100 million deal, you rolled 20 million forward into the new co. In a lot of cases, we're seeing clients get another 60, 80 million, even though they took all their chips, or a lot of their chips off the table in the initial transaction. So, having the ability to co-invest with groups like Riverside and Apex and Harvest, now KKR, is a great advantage for doing that kind of strategic backed by a private equity firm. It gives you a lot more flexibility and a better diversified investment going forward.
Yeah, very good.
Let me just chime in for a second here too, because obviously what these guys are talking about is, might be step 20 in your journey, to be honest with you, right? I mean, you guys, a lot of the people raise their hand for 0 to 10 units, right? I mean, that seems like a far bit away, right? Where you're going to sell for $100 million, right? What we've got to do is get you through the next 19 steps first, right? And so one of the things is that, all along that process, there are people to help you all along that process. And you've taken the first right step by coming to a conference like this, because there are lots of people in this room who can help you along that journey, right? And it might be with capital, it might be with advice. One of the things that Josh said that I would key in on is he learned a lot from the process he went through that didn't come to a successful conclusion, but it actually did, because it taught him what his priorities were and what he wanted to do with his business and the fact that he thought he could grow it and scale it. And so, what I would tell you is we talk about getting involved there, even though that might seem like 20 steps away, right? The reality is that the sooner that you start to talk to people and get an idea for what you might want and how to get there and what are your growth plans. Like, do you want to be 500 units, or do you do you just want to get, $5 million for your business and then go do something else because that's where your goal is. I mean, everyone has different goals. And so I would just say, take advantage of the people, the expertise, and realize that there's a whole stream of building your way all the way up through this process, and there's people to help you along every step.
Yeah. So I encourage anyone to ask questions. Just put your hand up if you have any questions as we go along. I'll keep my eyes on the room. You good? Okay. So going back to February, March of 2020, everything changed, right? 18 months ago, what has changed in your vision of franchising? Are the fundamentals still the same? Have you shifted what you're looking for? And what's the difference? What have you learned over these last 18 months that you could share? Anybody?
Sure, start.
Yeah.
I'll start real quick, and then, so a couple things that are pretty interesting. I mean, obviously, I've been to this conference a handful of times now, and the amount of home services, we were talking about this earlier, the amount of home services that's in this room is multiples of what it used to be, right? And that's partly driven by what's happened in the pandemic and the kind of asset light and service models that are very popular right now. But what's what I would say is that there are although business models have changed somewhat to accommodate for the pandemic and stuff, mostly there is interest, again, kind of across the spectrum. You just have to be willing to find the right partners, look for it, and search out, the people and the stuff that's going to help you be successful on that.
I think the resiliency of the business model was just reinforced by the pandemic. When you think about the lone operator that didn't have a franchise system to help them think through their PPP scenarios and how to handle this lack of talent and all of those resources, that's a really terrifying place to be. And the comfort of the system and the help has really been very clear. And so it's really solidified private equity's interest in this sector, and that's why you're seeing it at all stages, ranging from 10 units all the way up to multi-billion-dollar systems.
Yeah. And I 100% agree. I think one of the things that we used to always get asked is, how did the system do during '08, during the recession? Now everyone's like, how did it do during the pandemic? And home services franchisors did great in both cases. In '08, you saw a lot of corporate layoffs where, individuals went and bought, home services franchise locations. And during the pandemic, not only did the, same store, kind of sales and receipts grow, you also saw, again, people working from home, working from new locations, relocating from New York to Louisville, and buying home services franchise locations. So I think now private equity is looking at it going, wow, home services franchisors did great in '08, '09, and they did well during their pandemic. So they're recession and pandemic proof, which is only increasing multiples. And banks, the thing that we haven't talked about is lenders, private credit funds. They love recurring revenue. They love predictability. And the fact that the private equity firms can say, hey, look, we did great in '08, we did great during 2020, it allows the lenders to get more aggressive and provide better terms, which is, why multiples are getting to where they are. So,
Josh, any thoughts?
I would add to that from a franchisor's perspective, we've seen the mind shift really change, or the mindset really shift of the buyers, that they're much more open to service. I remember in 2012, 13 timeframe when I was at one of my first springboards and I told people what I did and what I was franchising, and they looked at me like, service, you're not in food, you're not in retail, you're not in a gym space, like that's franchisable. And so that mindset has really changed. And then for a lot of the lead sources, if you're not doing organic leads and you're working with consultant groups, a lot of those consultants have really shifted their mindset too, because they recognize that these businesses are low overhead, quick to open, quick to profitability, and we're getting much more lead flow. So we're able to grow at a much faster pace.
Yeah. My favorite saying I heard years ago in franchising was that you're in it for yourself, but not by yourself. And I think that sort of community really helped support us throughout that period of time. It was a really important time for us. A good friend of ours, Sam Ballas, who may or may not be in this room, really likes to talk about unit level economics and knowing your business inside and out. When it comes to looking at potential targets, how important is it that they truly understand their brand, that system, the drivers behind it?
I think it's critical for us. All of us were trained as financial weenies first. We were put through modeling classes and things like that, and so we come with that lens. But it's not just about investors, it's about running your business that way. What you're doing is gaining the confidence of your franchisees that you know your business and you run your business this way. You can't expect them to run their business that way if you don't run the franchisor that way. And it's inevitable how many, in our conversations with entrepreneurs, the ones that don't have good metrics and a good handle on it, how often they say, I know my business, I built this from the ground up, I run it every day. And then we have a special role in our firm called finance director. It's a type operating partner that will drop in and set up all the reporting and metrics and all of that for them. So we're not just telling them to do it, we're helping them do it. And it's amazing, though, how consistently they're surprised. They'll see the metrics and they'll say, your report must be wrong. No, can't be. Sure enough, it's not easy to run a business with that many variables and really know all those things off the top of your head without these metrics in place. But you'll gain the confidence of your employees, your franchisees, and investors if you know all of those numbers and track them. Not everybody has a mind to recite them off the top of your head. You don't need to memorize them. You need to be able to produce them quickly and have them on hand. Just the ability to shoot it out to them with the press of a button gives them the confidence. It's not that you know that location 3 in Atlanta is exactly, this metric for the last 12 months, but it's that you can produce the numbers.
So Anthony, you specialize in emerging franchisors, right?
Yep.
You could partner with any number of people, but you are selective in who you decide to partner with and who you want to associate with, correct?
Yep.
So what is it that helps define a relationship you want to have?
Yeah, so it's basically, it's 3 fundamental things for all my businesses. One is the partner. the founder or the management team running the business, that goes a huge way if I'm going to be working with them for a long period of time and trying to take them to the next level. Then, I want the right type of partner who's really going to, be open. None of us know everything there is to know about franchising or business or even the industry that you're in. So being able to surround yourself with more smart people and build the business is number one. Number two is unit economics, which we just touched on. I've never seen a concept fail that has great unit economics. It just doesn't happen. You can grow via franchising, you can grow via corporate, you can grow however you want, but it won't fail if you've got great unit economics. If you have poor unit economics, you might grow for a while, but eventually it's going to catch up to you. It's gonna fall apart. And then the third thing is, I like businesses that are a little nichey. So they have, the ability to grow. I don't want something that's too nichey where it can't grow, but I want something that's not, 100% mainstream where you're competing with guys that are $2 billion brands and stuff like that. But again, that's more personal. And again, like I said, there's partners out there for everyone. Everyone has different criteria, and if you just got to work to find the people who match up with what your business is.
Patrick, how about you?
I think Jay, what was the question again?
I don't know. I don't pay attention to stuff.
I can't remember. Sorry,
The question was, what are they looking for in emerging in brands that they're looking to
there's a
partner
lot of
with?
people that want to do business with you, but what do you look for in those people to decide if you want to do business with them? When you decided to do business with Josh, what was it about his fundamentals that really made you excited about
the
them?
thing we loved about Josh was the Fran Dev growth, and I think when you think about the 0 to 10 unit kind of franchisor, when I speak to some early stage, they really want that franchise fee to fund growth. Where we're big believers in franchise sales organizations like Fastlane, Fran Devco, Brand One, in really using that franchise fee to fund your network growth and making sure you're getting the right franchisees in the door. Getting the right franchisee in the door with good unit economics really allows for a franchise system to grow and become, an exit opportunity for you. So, if you don't have good unit economics and you don't have the best franchisees and you don't have growth, those are the three core things we look for. And to have happy franchisees, they have to be profitable.
Yeah,
That's
exactly
good.
Right. So Josh, turning that coin over a little bit, you could have gone with any number of groups. You picked Authority Brands. What did you consider? What kind of cultural things did you look at? What kind of shared vision? What did you look at that helped you make that decision?
Well, knowing that I was selling 100% of my interest, it was paramount to me to make sure that I really paired with somebody that was going to do the right thing with the business. We had a lot of franchisees. Being the first franchise system I was part of, there was a lot of those franchisees that were bought into the business because of me. Even though it was the team that we had built that was supporting them on a daily basis, that were there for them on their darkest days, we were very upfront when they would come in through a discovery process after the first few years that, even though you might be impressed by my story, you might like the infrastructure we're putting into place, it's not me that you're going to be calling on your darkest days. It's the team that we put around the organization to really support you. So I really felt in all of the potential organizations that we spoke to that it was just really a good fit. They were very interested in keeping the team intact and making very few changes. And I can speak from experience that over the last year that I've observed what's happening, because I still work in the same office building that they're leasing from me and continue to run the organization, that nothing's really changed other than they're actually growing faster than when I owned it, which is something to be a little jealous of. But it's been great. They actually had some development records that they set first half of 2021, and so it's rewarding to be able to watch that. But again, it's important to look after the franchisees, because knowing that I'm still involved in the industry, a lot of these franchisees came into our business not only organically but through various consultants in the industry, and word travels fast. So if we really left them to hang out to dry, it would really reflect poorly on me. So my reputation is so important that's really what weighed heavily into this.
Yeah, some of the biggest failures you'll ever see are where there's not that shared vision and you're not going towards the same goals. So having that alignment is absolutely critical. Jeremy, at what scale and inflection point does your firm typically have an interest?
So we've gone down market materially. While it's easier to write ever larger checks and ever larger companies, what we've found is that there is a huge pool of entrepreneurs in this business model that need help. And so with Threshold Brands, many of the concepts are in the tens of units, not in the hundreds of units. And in fact, one of them is a corporate unit, if you will. It's a single owner-operator plumbing HVAC business, which we plan to create a franchise system around from the ground up, which is fairly unusual, I think, in private equity firms that manage several $billion and have a global scope. But to Anthony's point, there's all those different types, depending on where your stage is, your industry, your focus, and you have to make sure that you find a partner that aligns with not only your stage, but your values, your brand, your management team, and where you want to be 5 years, 10 years, 20 years from now.
Yeah. So Anthony, you always want to skate to the puck, not to where it's at, right? That's hockey for you guys. That's hockey. A little inside
Highly
hockey
technical.
here. Yeah, very much so. So at what stage would you recommend people that have an interest that this is on their horizon, at what point should they be looking forward to doing that? You don't want to do it, the day you want to sell is not the day you hire a financial advisor. So what do you look for? What's the timing on something like that?
Well, the first thing that I recommend is that you start to get used to an annual planning process. Like, sit down once a year, take time away from the day-to-day from the business, and think about what are your 3, 5, 7-year goals for the business? Where do you want it to be? And how are you going to get there? Because without thinking about that, then you can't really define what type of help you're going to need along the way, right? Because some people will sit here and say, I want to grow faster. I want to be the fastest growing concept on the planet. And then some other people will say, look, I just want to be able to, keep a nice, consistent, steady income for myself. Or, everyone's got different goals. Or I want to own this for 30 years, or I want to own it for 5, right? And so once you've done that, once you've kind of thought to yourself, okay, here are the steps and here's what I want to accomplish, right? Then I would say immediately, right? Immediately start talking to potential advisors, right? I mean, at a conference like this, it costs you nothing to go up to Patrick, spend a few minutes with them, and just, talk to him a little bit about what your concept is, what you're trying to accomplish, and what you might, need to, do in order to be able to make that happen. And the more discussions like that you have, you'll start to zero in on the people who can help you accomplish those things. And you'll see, like, okay, well, I'm not ready for Patrick yet, but, here's somebody else who I met who I am, who is ready to, like, spend some time and invest some time with me and help me bring my goals to fruition. And so the sooner you start that, the better, because there are things that have real lead time. And the worst sale process that I've ever seen, I'm sure Patrick can relate some horror stories, is when somebody comes in and they say, I want to go to market in 3 months. Because there's just no way to avoid a surprise during that process. Because Patrick won't have the time to get to know the business well enough to flush out where there might be a problem that a buyer might have an issue with. And so then those come up during the middle of the process. And the worst thing you can do is be in the middle of a capital raising process and everyone gets a surprise moment. So, start your discussions early, get in contact with people. Even if selling, it seems like 20 years off, it's still helpful for you to figure out, what you would need to do, because things can change. You can go through health concerns, or you could, decide that your family doesn't actually want to run the business for you after you're done with it, or whatever, right? So things change along the way. So it's just very important to start that early, be more aware, start making the relationships, and see who can help you along that path.
Yeah, and start with the end in mind, like Lane was talking about a little bit earlier. Did you have a question?
Sure, guys. We're all wondering how, we don't need to know the brand names, but can you give us some specifics around how you come to the valuations? And then once those valuations are fairly much agreed to by both parties, then how are you structuring the deals? And real specific, real examples would be great.
Sure. Well, for me, it's very much a case-by-case basis, because, if you're a 10-unit franchise, some of the traditional metrics, multiple of EBITDA or things like that, are not really gonna make sense, right? So a lot of it tends to be, I'm a minority investor. I like the founder to have the bulk of the founder or founders to have the bulk of the upside. And so for me, I'm usually looking for somewhere between a 10 and 30% stake. And so the question, generally my discussion around purchase and investment and things like that, so it gets more on, how much capital are we going to need in order to be able to get where you want to go in 3 or 5 or 7 years? And, and can, I provide that and feel comfortable that the upside's there if I take somewhere between 10 and 30% of the business. So it's much more amorphous, I guess, than, I know you want a specific answer, but at that stage, it's much more amorphous. Now, as my concepts grow and, and if they need to do further fundraising rounds and they're generating significant positive EBITDA and stuff, then it becomes much more of a multiple, very specific financial metrics on the valuation. And I'll turn it to these guys for more on that.
We talk about the industry, the slang are multiples, quote unquote, and what they mean is the multiplier of EBITDA or free cash flow is what we really mean. But that's not really necessarily the way the sausage is made. That's just easier for comparison purposes. But the reality is we look at a mosaic of factors, not the least of which being your split of revenue between royalty and new unit sales. Nobody wants to admit it, but we place effectively a 0 multiple on new unit sales, right? That's not supposed to be your driver of profitability. That's supposed to be covering your training and getting them going and all of that. But what we're really focused on is that recurring revenue model and that royalty revenue. The amount of white space left matters, scale matters for financing reasons. In the event that it's a control acquisition, most private equity firms will use some form of debt. And the availability of debt has a huge impact on how much you can pay for it. The reality is the market bears some ultimate number through a competitive process. You'll arrive at something. And then what we're doing is backward math. So we're taking these beautiful projections that have been presented to us, and then we're scrubbing those down to try to think what can we show as a base case to our investment committee that seems reasonable and achievable, and then comparing that to what we think the return parameters could be that would make our investors happy. But I'm sure Patrick's seen more facets from more bidders.
Yeah, I mean, absolutely. I mean, it all comes down to EBITDA, but the bidding process and the competitive nature of the industry at the moment is, valuations are really high, and they're, making sure there's 3 or 4 groups that really want an asset. When you call back one private equity group and say, hey, you lost, they say, well, can I come up $5 million? And so then you call back the other group and say, hey, somebody else just came up $5 million. You need to come up $7 million to win the deal. And so, it almost gets, not to compare it to an art auction where you got bidders in a room, but, you have to define the EBITDA and make sure it's rock solid. We tend to do a sell side quality of earnings before going to market with our clients. That way we know the number's real. And so everyone's bidding off the same financials. But, at the end of the day, it comes down to how excited that private equity firm is or that buyer is about your brand, your management team, your royalty stream. As I said earlier, no one wants to pay for new franchise fee income. It's all about royalties and rebates. And that's something else we didn't really talk about rebates, but when you're putting together your first, FDD and FAs, make sure you've really thought through where you can get rebates and have the suppliers fund the rebates, not your franchisees. Rebates are an amazing way to add value to your franchisor if you get them right. And a lot of vendors to your businesses will give you really good. We've actually had clients that didn't have fairly robust rebate programs where we've come up with them during a process and got them paid off these rebates. So just make sure you put that you think through all the different vendors you have for your franchisees and how you can get them to help fund more growth and more bottom line. But EBITDA is the key, but then it's also making sure you have 2 or 3 parties that really want your franchise or your business, and somebody has to win. So.
And that advice was worth your entry fee for being here today, guys. So, Josh, you've really become the master of dealing with emerging franchisors and taking them from 5, 10, into hundreds, right? Why are you successful, and what is really driving that? How are you really moving this forward?
So a big part of it is the investment we make into everything that we're doing, not only from a development side, but also from an operational perspective. We really focus on making sure that our franchisees are successful, and I know that every franchisor in a room is going to say they do the exact same thing, but what a lot of franchise owners don't realize is they don't put enough people in place to touch their franchisees frequently enough, or really break down the departments to have dedicated areas that you're really supporting your franchisees. Individuals are wearing more hats than they probably should be. So we're very focused on making sure we do that. Like the most recent acquisition we made with Mighty Dog Roofing late last year. When we launched development at the end of 2020, we had a staff of over 20 people at that point. So while for an emerging brand that doesn't have financial backing or the capital to do that, that's very difficult. So you end up wearing a lot of hats. But I know with the type of growth we bring to things, we make it look very easy. And I think any robust brand or any large franchisor makes franchising look easy, and there's a lot of work that has to be done. And so we're fortunate that we can set all of this stuff up out of the gate and then continue to monitor it and put the right people in place and really track everything. And from an executive level, we really rely on the teams that we put around us so that we can really act in a visionary role and continue to surround ourselves with all the integrators that work for us on our teams and stay almost hands off to the day-to-day of the business so that we can really play devil's advocate with certain things and challenge our team continuously on areas that we believe are weaknesses in the business or that they really need to focus on improving. And then more importantly, the senior leadership does invest time in reaching out to our franchisees. So as a CEO, I typically try to take at least 30 to 60 minutes at a minimum once a year with every franchisee in the system to understand what we can do to get better and improve the process for them as well. And what we found is that by making that investment of time really gets you the raw data that you need to know where you need to improve. We all, as franchisors, think we know what we need to improve, but it's really our franchisees that are going to tell us the areas that they need better assistance in.
Very good. Any questions?
Hi. Angela Cote here. What I think I'm hearing you say, Josh, is like active coaching versus just supporting the franchisees, getting in there with them. What is your recommendation for how often, how are you coaching franchisees? How often is the franchise coach engaging with them?
So we set up operational people across the country on a regional basis and then assign franchisees to them. And then first year in business, the franchisees for the first 12 months have to have monthly business review calls. So they're setting all of their budgets, their goals, and we like to call them rocks for monthly and quarterly rocks for their business. And we're holding them accountable to that. And then starting in year 2 or month 13th, we'll move them to a quarterly business review call. And so what we find, one of the number one reasons franchisees are looking to buy a business oftentimes is they're tired of working for somebody else, building somebody else's dream, or as I hear, they're tired of being micromanaged. But I always throw it back in their lap and say, I think you owe a debt of gratitude to the individual that might have micromanaged you up until this point of looking for a business because you may not have hit your goals if you didn't have somebody holding you accountable to it. And so business ownership is a newfound freedom that we have to be that person to step in and, really monitor what they're doing and continue to coach them. We don't approach anything in any of our businesses from a one-size-fits-all, so I know that franchising is largely about systems and processes. We try to approach it more from a SWOT analysis and understand each individual owner, what their strengths are, and in the areas that they're weak, we really work with them to support them to continue to grow it. But we don't just say that we do these things, we actually do, and then through all of our reporting that we expose them to, and this is what is very impressive to the candidates that come through our process and join our organizations, is the level of data and reporting that we give to them so that they can really see everything that's driving the needle in their business. So we can approach everything from what I like to say is proactive versus reactive. We never want to be spending our time fighting fires. We really want to identify issues within their business early on.
Okay, any other questions from the field?
What do you look for in investing or helping those, like you said, the guy without the name tag now.
Jeremy.
You'd said you're working with a guy that doesn't have any franchises yet. What do you look for in those individuals or those emerging franchises as somebody you're willing to work with or interested to work with? Obviously, a profitable 4 or 5 franchises is good, but what other
Yeah, it
attributes?
goes back to the unit economics. We met an entrepreneur that is running a business that's about a like size to a franchise concept. Great systems, great culture, and really just echoed the success stories we've seen before. And we had enough enthusiasm to take a chance on him as a leader, and he wants to have these resources put around him. But he's also talked to a lot of people that have made a lot of mistakes in franchising, so he always wanted to do that, but he didn't want to do it the entrepreneurial way and learn through experience. He wanted to learn from our mistakes. We already made the mistakes, so why make them all a second time? So he wants to participate in that journey, but de-risk it by having a financial partner. And so it's that meeting of the minds that you're on the same page, in addition to just the profitability and obvious financial metrics.
The other thing that I'd chime in on is just replicability, right? I mean, franchising is about, rinse and repeat, so to speak. And so when you're looking at, an emerging franchise, something that's, just up and coming, what you're really looking for is how easy is it going to be to replicate, their model over and over and over, 100 times, 200 times, right? And so, the more you can simplify the process for the franchisees. I know one of the earlier things on operations was about simplifying, right? The more you can make it easy, the more, you can have a broad swath of franchisees, meaning, you don't need like a 40-year-old woman who's, got 3 kids, whoever, to be your franchisee because they're the ideal partner. You want to be able to appeal to a whole, wide swath of people. So things like that make it easy to draw your head around replicability and growth will matter a lot as people look at investing in the early stages before you've kind of proven out that it can be 100 units.
Okay, so I can tell by the look on Lane's face, we're getting close to the end here. So what I'd like to ask you gentlemen, we're like in the 2-minute drill right now. The Cowboys are coming down to kick that winning field goal tonight against Philadelphia. Take my word, take it, take them. Money line, bet the money line on the Cowboys. Let's start with you. Give us your parting shot, and let's bring it this way.
Just to reiterate what I said earlier, make sure you surround yourself as you build your franchisor with really good people who know franchising. Most law firms that don't work in franchising aren't the right advisor typically for a franchisor. We see it way too often. Make sure your accounting firm knows franchising. There's a lot of changes in RevRec and other policies. But when you're building your franchisor from 0 to 100 units, make sure you know what you want to achieve. Do you want to keep it for 10 years or are you trying to sell it in 2 or 3 years? Investing in an FSO relationship makes a lot more sense if you're going to sell it in 2 or 3 years. So just make sure you map out where you want to get to so that way you can make sure all your advisors are on the same page.
All right, Josh, you're on the clock.
For me, as far as maximizing exit, it's really thinking through what Patrick mentioned earlier, dialing in those rebate programs, making sure that you've got those signed contracts. It's very easy to overlook that because you think as an early franchisor or an emerging brand, you want to do all you can to try to minimize cost to your franchisees. It's not going to make a difference. Get those contracts in place. Additionally, I challenge everyone to increase fees outside of just your royalties. Think of everything, including tech fees. It's okay to raise those fees, and instead of charging them annually, move them to a monthly or quarterly fee. As an example, in Mighty Dog Roofing, we actually charge a $7,500 annual tech fee. So our tech fee is much higher than the typical $1,000 or $1,500 that you see. And then more importantly, remove yourself from the day-to-day of the business as much as possible and surround yourself with your successors that are going to be able to carry the baton when you make an exit. Because like myself, many entrepreneurs are not employable people. So you don't want to go forward and have to work for the person that buys you out.
Now there's some good advice. Jeremy?
Great self-aware.
Investors are really good at asking you questions, and you get psychologically back on your heels answering the endless lists of questions that we can shoot across. And you need to make sure that you do diligence on that partner Don't just call their success stories, right? So it's real easy for me to say, call Dina Dwyer or Mike Bidwell, but ask for references or find on your own references of ones that didn't go well. And really make sure you know who you're partnering with culturally. And if you have a bad gut feeling, walk away. There's another investor out there. Follow your gut. There's more than just data and money and the stories, because this is going to be a real partnership for a number of years to come, and you need to make sure that you know who you're in business with, not just the headline number. So, there's a lot of creative people in our industry that give you this $100 million headline number, but the devil's in the details. And with the right people, Patrick, legal counsel, accounting firms around you, they can help translate that creative structuring into English and let you know what that really means. But the more complicated it is, the more you need to be on guard. Usually the simpler the better for most scenarios.
All right, Anthony, bring us home.
I would just end by saying time and money. Those are the two most scarce resources for emerging brands, right? Time and money. You're going to hear a lot of things that you should do, a lot of things that you're going to say, I can't afford to, or I don't have time to do that, or whatever. That's where you really need to do your best to bring in outside help, because that will give you the time and money to execute the right way. And there'll still be plenty of upside left in it for you, over the long term. But you really need to make sure you do it right, or it's not gonna pay off for you either way.
All right, a round of applause for our brilliant panel.